morning. Welcome back to the Real Investment Show. I'm your host, Lance Roberts. It's this Monday as we get, like I said, this last week of July. And I want to talk a little bit about what's about to happen here over the next couple of weeks and the potential impacts of that. We wrote an article actually a series of articles over the last couple of weeks called MMT, the theory of MMT falls flat when faced with economic realities. And modern monetary theory, if you haven't heard anything about it, I suggest you go by the website, realinvestmentadvice.com, read the articles that we have on it. But the important thing about that is that the theory suggests that basically you can just run debts and deficits without risk as long as there's no inflation. But of course, we've got to have a valid measure of inflation in order to justify that to some degree. But the consequence of debts and deficits have been, for a long term, weaker economic growth, weaker prosperity, et cetera. Now, we know that, right? We can look at the data and tell that to be the case. Now, it's interesting right now because, our senators and congressmen are coming back from their summer break, and they've got to get back to work here, passing more stimulus bills, right? This is the hope, is that over the course of this next week, we'll have a new bill, probably in excess of $1 trillion, just $1 trillion. Just $1 trillion bucks, to basically fund additional benefits, additional payouts, support, municipalities and a whole variety of other pet projects of our Congress. But we don't really talk about the implications to this long term for the economy. Now, there's typically some ideas that come out from the mainstream media, and this is an example of one this morning. The headline fiscal balance percentage of GDP. So this is the deficit relative to gross domestic product, the size of the economy. And we're approaching levels now that, we haven't seen since World War II. And this is pretty dramatic when you think about it, but there's a huge, huge set of differences between today and what we saw back in World War II. First of all, the size of the economy today is magnitudes larger than it was back in World War II. And back during those times. And so, yes, when we talk about deficits being as a percentage of something, yes, this is pretty dramatic when you put this on a chart, but there's a massive difference between the size of the economy today and also the makeup of the economy today versus what was occurring back in World War II. Corporate debt is at all-time records. Household debt today, all-time records. Those didn't exist back in World War II. But here's a long-term chart of debts, deficits, and economic growth going all the way back to World War II. And now this is the actual debt and deficit, right? So take a look at the debts and deficits that we're running today. This is going to be marginally larger over the course of the next 12 months as we issue more debt to fund all these programs. But here's the size of the debt in World War II. You can barely see the amount of the debt and deficit that existed in World War II. But yes, as a percentage of the economy, they were the same. But also look at the difference. GDP growth on a 10-year average was growing at roughly about 9 to 10 to 12% back during World War II. Because why? We were producing everything for the war effort. So yes, while we were running debts and deficits back in World War II, we were issuing war bonds, etc. Those were assets of individuals that were loaning money to the government to build stuff. We were building tanks and planes and ships and building materials for the war effort. Everybody was working. If you weren't in the military and serving, you were in a factory manufacturing something for the most part. Women went back to work in the factories to produce the planes, the trucks, the planes, everything else that we needed for the war effort. Everybody was working. And notice that after the war, though, immediately that debt and deficit was reversed and was paid off. Those war bonds that became the assets of individuals were paid off shortly after the war effort, and we began growing the economy. As Johnny came back from war, he began to build houses and start families. The women left the factories to raise families. They created businesses, and they grew the economy sharply in the 50s and the 60s. Now notice this, is that once we began to actually increase debts and deficits here, ever since we've been running bigger deficits, economic growth on a 10-year average has continued to slow. That's because debts divert economic activity away from productive investments like building stuff into social welfare, which is what we're seeing more and more of today. So yes, we are talking about passing more debts and more deficits. $1 trillion, to put in perspective, if you spend $1 million a day since Jesus walked the earth, you still wouldn't have spent $1 trillion, and yet we're dropping $3 trillion this year just on social welfare. And we've got to have an expectation, yes, we do have to pay that back. At some point, whoever owns that debt wants their money back. We just don't get to write it off and walk away. There's consequences for that in terms of the value and perception of the economic value of the U.S. when you begin to default on debt. It's not a good thing, and it's not a good thing long term for the generations that are coming up behind us. So pay attention to this. This is very important. We're about to have this big conversation. Everybody wants more free stuff. I got it. Everybody wants the help. Just understand there's a consequence, and that consequence is lower wage growth, lower economic activity, fewer jobs. All that's the consequence. More automation, more productivity, more outsourcing of labor to cheaper sources of labor to produce the products that you want to consume because you don't have the money to pay higher prices for it and don't want to. This is the problem that we face today. It's also the very same problem that Japan has faced for the last 30 years. Just because it's a different country doesn't mean the outcome's not going to be the same. A couple other things here real quick, though, as we get ready to go this morning. Here's that chart of the spike in the increases in virus cases. As I said, this is expected to peak in mid-August, about the time that flu season starts. So again, kind of pay attention to what's going on there. As we talk about all these type of things going on, we had this initial boost off the bottom. People got very excited about the reopening of the economy. That started coming back. We saw an uptick in consumer confidence, very important to the overall economy. That's begun to fade here over the course of the last month or so, as the realization is that a lot of these temporary layoffs are now becoming permanent and the economy is slowing down. The problem with this is that there's a high correlation between consumer confidence and returns on the markets. I'll show you that in a second, but here is what happens over the course of August and September typically as we began to get into the next couple of months. And again, as I said, there's a very high correlation between what happens with consumer confidence and returns from the stock market. Right now, there's a big deviation. But as we get further into summer and begin to see the impact of slower earnings, weaker earnings growth, worse growth in terms of revenues and GDP, this is very likely going to start playing a little bit of catch up here. So again, August, September, biggest risk to the markets here as we go forward. So pay attention to what's happening there. And again, as we continue to think about these issues about debts and deficits and more spending, there's a consequence. And we tend to not think about the consequences because we want the here and the now, right? You know, if I'm out of a job, yes, give me more money, give me more benefits because it makes me happy today. But there's a consequence for doing that long term. And we keep digging the hole deeper and deeper, expecting that, well, maybe next year, we'll magically get some type of economic growth. For the last decade, it's been an annual promise that next year we're going to get stronger economic growth. Next year, we'll get stronger economic growth. We're going to have to do more this year, more debts, more deficits this year. But next year, we'll get stronger economic growth and we'll start to reset the table. It never happens. And so we keep digging that hole deeper and deeper and deeper, hoping that next year, well, we're going to get inflation. Next year, we're going to get stronger economic growth. Next year, we're going to have all these things. But, we don't quite ever get there. And we continue to dig this hole deeper and deeper and deeper. And again, as the hole gets deeper, then politicians are inclined to give more money because that keeps them elected in office. And so, the tough choices, we don't want to make those. We don't want to make those tough choices that will actually lead to better economic prosperity long term. We want the easy answers today in hopes that somebody else will take care of those problems later on, but that simply never becomes the case. Recessions have become a thing that we fear. We don't want a recession. Oh my gosh, we can't have a recession. That'd be terrible. But recessions are supposed to be the part of the economic cycle that kind of resets the table and allows things to revert, those excesses to be cleared out so we can have stronger economic growth. And we've equated this before. Forest fires are not a bad thing, right? It allows the forest to become healthier over time. And it's the same thing in the economy. But today, because of what we've done with the Federal Reserve and the bailouts, we actually have more corporate debt now than we did before we actually got into this problem. And it was a problem to begin with. So by not allowing companies to go through the bankruptcy process, by keeping zombie companies alive through cheap debt and through cheap interest rates, it has not allowed that cycle to complete to allow for better economic growth. And because of that, we continue to hope that we're going to get better opportunities down the road, that somehow magically free money is going to be the answer to everything, but it's not. And ultimately, at the end of the day, we wind up in the same situation that we've seen every other country wind up in that's gone through this process before. And again, you don't have to look far. I posted a chart out over this weekend talking about Japan. 30 years ago, Japan followed the same path that we're doing today. 30 years later, their markets, the Nikkei, is 30% lower than where it was 30 years ago. Economic growth is the same as it was 30 years ago. Economic prosperity hasn't improved. And, they have a huge pension system, that's their Social Security system, that's very dependent upon government debt to continue to fund it, to keep it solvent. And very much an aging demographic. We have the same problems on a relative basis that we have to Japan. We can watch what's happening in Japan in a microcosm, and yes, Japan hasn't blown up yet. And because they haven't blown up, we go, hey, well, maybe this time will be different. Maybe the U.S. is different. Maybe we can do the same thing and come up with a different answer. But that is very rarely the case that happens over time. And we can tell from the anecdotal evidence that we're heading that direction. But what's being sold to the Gen Zers, what's being sold to the millennials, that, hey, free stuff is a great thing. But the consequences are going to be slower economic growth, weaker wage growth, less prosperity, a widening of the wealth gap. The very things that they're railing against that they don't like are the very things they're helping build by wanting more free stuff. Want free college? That's great. Leads to lower economic prosperity down the road. And that's just a function of what happens over time. Okay, quick break. We're going to come back, pick up with a little bit about the economy, the markets, kind of the upcoming election. Got a lot of stuff to get into this morning, so stick around. More of the Real Investment Show coming up. I'm your host, Lance Roberts. Don't go away.
Psychic spies from China try to steal your imagination. Little girl from Sweden dream of silver screen quotations. And if you want these kind of dreams, it's Californication.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.